The previous lecture discussed about financial assumptions and forecasting. Financial assumptions is where the proponents make series of assumptions on the possible outcomes and effect of the chosen alternative. Forecasting is where the proponents make forecasts on the selected important financial data by their natural course. Good day, I am Crystal KP Adriano and I will discuss the other part of the financial plan, which is the cash budget. By the end of this discussion, the students must be able to first understand the use, second is to identify the types, third is to determine the components, and fourth is to learn the preparation of the cash budget. A cash budget is made as part of the company's master budget. The master budget encompasses the complete budgeting process and it includes budgeted income statement, budgeted balance sheet, and lastly the cash budget. A cash budget details anticipated cash receipts and disbursements for the time period covered in the budget. The cash budget includes the amount of projected financing the company will need during that time period. Cash budget as defined by Dr. Casurao. Cash budget shows the cash requirements or excess funds during a period of time. Cash budget is also an estimation of cash inflows and outflows, cash from operations, interest expenses on existing loans, minimum cash requirements, estimated cash deficiency or excess, loans needed to be obtained, and lastly, the cash balance. According to Julian, the primary purpose of cash budget is to provide the company's cash position at any given time. Cash budget also helps the company make critical decisions such as creating cash reserves to make arrangements for projected shortages and using excess funds prudently. Also, cash budget helps in analyzing budget versus actual variances in cash inflows and outflows. Also, according to Davern, there are three types of cash budget. First is the short-term budget, second is the interim-term budget, and lastly the long-term budgets. Short-term budgets aim to solve cash requirements on a weekly or monthly basis. Short-term budgets help forecast payments that need immediate fund allocation and identify sources to help offset this requirement. Next type of budget is the interim-term budgets. Interim-term budgets is typically meant for 12-month periods. These are usually created at the end of the year for the succeeding period based on the current year's transactions. The last type of cash budget is the long-term budgets. Long-term budgets are predominantly spread over the years. This budget aids decision-making, especially on capital investments on machineries and infrastructures, business diversity plans, and manpower projections costing. According to allbusiness.com, there are three main components of cash budget. First is the receipt section, second is the disbursement section, and lastly is the cash surplus or deficit section. So now we proceed to an example of cash budget taken from the financial plan of the students of finance of PLM last 2015. So as we can see here at the first part, this shows the receipt section, which includes the beginning cash balance, cash on hand, and the accounts receivables, which are estimated cash receipts. At the second part, we can see here the cash disbursement section, which shows us the estimated cash outflows for the period, like the loans payable, the interest expense, income tax payable, and the other payables. At the third part, we can see here the cash balance or ending. Cash balance or ending is computed by deducting cash disbursement from the cash receipt section. So now let us proceed to the preparation of the cash budget. According to Harvard Mentor, the following are the steps in preparing the cash budget. First is determining the beginning cash balance or determining how much money or cash is available at the beginning of the period. Second is adding the receipts. We should determine the expected receipts, cash collections from customers that will flow into the cash account each period. Third is we should deduct the disbursements. Based on expected activity, we should calculate how much cash will be required to cover the disbursements or cash payouts during the period. Next step is to calculate the cash excess or deficiency. To calculate for the cash excess or deficiency, we should subtract the cash disbursements from the sum of the beginning cash balance and the expected receipts during the period. Next step is we should determine the financing needed. If at the end of the period, there is a cash excess, That means financing of operations can be covered using the available cash. However, if there is a cash deficiency, that means you need to plan on financing the period's cash needs on getting from other sources such as bank loans. Last step is establishing the ending cash balance. The ending cash balance for each period will include receipts and loans, less the disbursements and the financing costs. The ending cash balance will now be the beginning cash balance for the next period. So here is another example of a cash budget prepared for the last year's financial plan. To summarize, cash budget is used for cash planning and control that presents expected cash inflows and outflows for a designated time period. The cash budget helps management keep cash balances in reasonable relationship to its needs, and it aids in avoiding the cash and possible cash shortages. It has three types: the short-term budget, the interim-term budget, and lastly, the long-term budget. It has three general components: the receipt section, disbursement section, and lastly, the cash surplus or deficit section. In the preparation of the cash budget, the surplus or deficit that is reflected by the cash budget will suggest what action does the company need to do. That will be all. Thank you.